What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this episode of Hidden Forces is the University of Texas at Austin's director of the Center for Politics, Economics, and History, and until recently, the Henry Kaufman Professor of Financial Institutions at Columbia Business School, Dr. Charles Calomiris. What prompted this conversation was a paper written by Professor Calomiris about a condition known as fiscal dominance, in which he examines the possibility that the United States government may eventually choose to enact new and more onerous forms of financial repression, including the commandeering of the U.S. banking system in order to fund itself. In the first hour, Charles and I discussed the history of U.S. bank policy and the unique characteristics of the American political economy that inform how the nation responds to political crises and the populist temptation to use the banking system to resolve them. The second hour is devoted to a discussion about when and how such measures will be taken to resolve an impending fiscal debt crisis that Professor Calomiris believes is inevitable. We discuss what some of the signposts of such an impending crisis could be that would warn the public and investors, what an economy operating under the conditions of fiscal dominance would look like, including trade-offs between government spending and private investment, how such a period of fiscal dominance could end, either through a prolonged period of double-digit inflation or a full-blown debt crisis, and what role fintech, crypto, and decentralized finance will play in such an economy, given the Fed's need to fund itself without losing complete control over inflation. This is another phenomenal conversation on a subject that we have explored at length in previous episodes of this podcast. If you want access to all of it and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. And with that, please enjoy this extremely educational and forward-looking conversation with my guest, Professor Charles Calomiris. Charles Calomiris, welcome to Hidden Forces.
It's great to be with you, Demetri.
So, Charles, this has been a very long time coming. You and I were in touch years ago. I think I reached out to you in 2017 or 2018. We were just trying to figure out where it was that I had first met you. And I feel like my knowledge of your work goes way before that, probably from academia, from your contributions in academia. And yeah, I think over the years, you were always on CNBC and Bloomberg and stuff like that. The reason that I asked you on the podcast is to talk about a recent paper that you published, and we're going to get into that. But before we do, I would love to know a little bit more about you and your background. I know you've worked for a long time in academia. I know you were chief economist for a period at the OCC. So what is your deal? Like, you're an economist. Where have you spent most of your career, and what kind of problems have you spent most of your career working on?
I was a PhD student, got my PhD at Stanford in the early 1980s in economics. And interestingly, the topic of my dissertation is very much related to the paper we're going to talk about today. In fact, almost identical in terms of questions and motives. And in that dissertation, I was mainly exploring historical examples of the kinds of problems, fiscal and monetary problems, that we're going to talk about. So I've been working on that topic since I was a little kid. And then in addition to these kinds of, let's call them macroeconomics and public finance topics, I became very interested in banking and finance in the 1980s too, and do a lot of work in that area, as well as corporate finance more generally, which has to do with strategic choices of businesses, how to run their financial affairs. So I guess I would say it's monetary economics issues of the connection between monetary economics and fiscal policy, banking, and especially its regulation, and then corporate finance more generally.
So I know you've written quite a bit about history and the history of bank regulation. You covered it in Fragile by Design, which is a book that I think you're most closely associated with. How important is understanding the history of banking and bank regulation and the relationship between the government and the private sector in being able to make reasonable projections about how the current fiscal and monetary situation is going to be playing out?
That is such a great question. And Demetri, I very rarely am asked that question. I wrote a book with Steve Haber in 2014 called Fragile by Design. And in that book, what we tried to show was that at least with respect to understanding how banking systems function and how they're regulated and kind of what's feasible, that you have to take a historical approach, because the historical approach helps you define who the political coalitions are that are going to be successful in winning the day to decide what the regulations are. So regulations don't just come from the minds of economists or even politicians. It's not like it's all about ideas. And I think sometimes the way it's taught in economics departments, it's as if government policy is all about, do we have this idea? Oh, wow, we got this brilliant theorist who finally told us what we need to do. I think that's a joke. The way that economic policy actually happens is you start with what's feasible within a country under the political coalitions that are dominating the country. And I know this may sound a little Marxist, but not everything Karl Marx said was wrong. And this one, the idea that you actually have to understand economic policy through the lens of political power, I think is absolutely essential. So for me, both when I'm thinking about fiscal policy questions and monetary, like we're talking about today, or bank regulatory policy, if you don't study the history of a country, you don't really understand what's going on. So for example, suppose that you asked anybody on the street right now today, how is the US government going to solve the fiscal overspending problem that we currently have? So they could give you 1,000 answers of how we might solve it. But if you don't know what the history is of the US and how that has changed over the past few decades, if you don't have a historical basis for understanding how the politics is moving, how could you possibly answer that question?
So that's a great point. And it reminds me of a lecture that I heard you give many years ago, where you talked about the differences between the US banking system and how it's regulated versus the Canadian and the Australian banking systems. And you explained those differences, I remember, in terms of each country's founding history. And you made this great point that the US was founded by rebels and troublemakers, whereas the Canadians were seeking to preserve a stable liberal polity and not, upset the apple cart too much. Talk to me a little bit about what's unique about the US that is particularly relevant to this conversation in terms of how the banking system is regulated and the purposes that the banking system serves for institutional power.
Well, now going back in time, of course, as you pointed out, America begins as a revolutionary country. And as a revolutionary country, despite all the checks and balances in our federalist system and our three branches of government, at least as it was conceived, despite all those checks and balances, it still is a country with a strong populist bent. And that populist bent gets reflected initially in bank regulation as a rejection that happens in the early 19th century of the kind of privilege model that was set up by people like Alexander Hamilton. So initially we had, a handful of banks being chartered, and the idea was that, we might even have a branch bank that operates through the whole country. The Bank of the United States was conceived that way. But very quickly, a different political coalition that has strong agrarian and much more local kind of focus ends up dominating. And the model that we adopt is one of local banks, so-called unit banks, typically with only one office, that are operating in a way that's supposed to create access for credit in agricultural areas. I say supposed to because it's not clear that it really achieved that objective. But the point of that is that the whole chartering policy, the regulation in banking isn't just about the kinds of things that we hear about today, but it's also about who gets to be a banker, where does a bank get to be located, so that those policies really changed. And by the time you're, let's say, in the Jacksonian era, you get this kind of general rejection of privilege, which is really something that was cooked into the cake from the beginning, I would say, as a revolutionary country. And all of a sudden, we have, for 150 years in U.S. history, we have this kind of agrarian-dominated regulatory system of unit banking. That changes in the late 20th century, and we get a new political coalition, which we could talk about. But that's really the nature of it, is that I think that as an American, I would say a lot of us are taught in school to think that our Constitution is set up to be the perfect liberal democracy, by which I mean a democracy that, through checks and balances, empowers the system to sort of focus on the collective good for the individual. And of course, that's true in a lot of respects. But in banking, you see something a little different. You see the way that political coalitions use those rules of the game to set up the rules of engagement for banking with particular bias, and basically to use the banking system as a way to favor some groups over others. And that's been the history of banking in the U.S. all along. You mentioned Canada. And of course, the difference is Canada was a country that was conceived to remain part of Great Britain. Great Britain still has Canada Day. And the idea there in the Canadian Constitution was to create institutions, particularly in banking from the very beginning, that were conceived in such a way that they would be more impervious to the formation of what you might call special interest coalitions, to use the banking system to favor one group at the expense of another. And there were times when in Canada, there were attempts to create banking policies that were more similar to the U.S., especially in Western Canada. The same kind of agrarian-focused policies were attempted, but they were rejected because of the structure of the Senate in Canada, and also more generally the Constitution and the way the Constitution of Canada favors centralized economic decision-making. So if you didn't study the histories of the U.S. and Canada, and more deeply what they're trying to achieve given their different fundamental initial origins of political history, it would be hard to understand why the Canadian banking system has never had a banking crisis, whereas the U.S. has had, more than 20.
So I'm glad that we had a chance to touch on this. We're going to get into it again later, maybe in the second hour, when we hopefully have a chance to talk about what's going on with regional banks and this move towards centralization, and also fintech and crypto, and what role these sort of emerging technologies or established technologies could play in the type of fiscal dominance scenario that you write about in your paper. So again, the reason that I had originally asked you to come on the podcast was because of this paper that you published, which for people that aren't familiar with it, the paper is titled Fiscal Dominance and the Return of Zero Interest Bank Reserve Requirements. And to summarize, the paper examines the possibility that accumulating government debt and deficits could, perhaps sooner than the consensus expects, produce increases in inflation that dominate the Federal Reserve's intentions to keep inflation low. And you also examine how the U.S. government and U.S. government policy, especially bank policy, could adjust in such a scenario. Did I summarize that correctly? And
yes,
would you like
you sure did.
Okay, great. So then maybe would you like to expand on it in that case, on the description and what it is that you sought to achieve in writing this paper?
Yes. So just following your summary, let's just summarize it with three sets of ideas. So first of all, arithmetically, there's no disagreement. In fact, the U.S. Treasury's own report has recognized that under current U.S. policies, that is, unless there's fundamental change in the status quo, especially with respect to entitlement policies. So unless there's a major change in the existing promises of entitlement policies, the existing structure of tax policy, and military spending too, but let's just say entitlements and tax rules. If there is no change in those, we are on an unsustainable path in terms of our total amount of accumulated deficits. an unsustainable path simply means that at some point, the bond market will not absorb as a real amount the amount of debt that's being issued. So what we all agree in economics about is that there isn't an infinite demand for anyone's real debt, by which I mean, if you want to, Demetri, give me an IOU of yours, I might be willing to take a little bit, but I'm certainly not going to lend you an infinite amount.
Hopefully you'll take more than you would have after spending some time with me on this podcast.
Certainly. I'm probably going to go up to like, I don't know, $15, $16, you know, I mean, you look good for it. But the thing is, that's true of the national governments too, that the market just isn't willing to lend anyone infinity.
At the prevailing price, at a lower price.
Or at any
price.
You can't lend infinity, right? You can't say, I'm going to pretend that I believe that you will pay back, you know, an unlimited amount of money. It's not possible. And so we call that sustainability condition. It has a lot of formal names in math, but it basically just says, if you're on a path like that, at some point, and it can be hard to say precisely when that point is, but history is a guide to us in thinking about that because we have lots of episodes of this. At some point, the bond market says, sorry, literally, I'm not buying it, right? I'm not believing that you're going to be able to pay back in real terms any more than what you already have issued. And then what that means is you can't use the bond market incrementally to raise more funds. And so you have to come up with new ideas. And traditionally, in all of world history, when governments hit this point, they tend to revert to the printing press. But people, I think, misunderstand what the printing press can do. So yes, it's true that government, because it has a monopoly in the US on the supply of dollars, it can spend, instead of borrowing dollars by issuing bonds, it can just print dollars, basically command the Federal Reserve or pressure the Federal Reserve to print money to buy the US government bonds that the market doesn't want to buy and issue much more money, and the result will be more inflation. I think that what people misunderstand about that, there's nothing wrong with that understanding. That is correct. But then the question is, how much funding can you get with that process? So I'm still summarizing my paper. I'm sorry, it's such a long summary. The first thing to say is that we're going to hit a fiscal dominance problem. It's a matter of arithmetic. Unless current policies change, we will hit it.
So just to clarify something, I want you to continue, but I want to clarify something. So, because you threw out a few terms here, let's just clarify what fiscal dominance is. Is fiscal dominance the moment at which the yields on government debt become discontinuous? They begin to rise so quickly that basically the debt becomes unfundable? Is that what fiscal dominance is? Or is it the moment in which the U.S. government begins to, quote, print money? And then let's clarify what printing money is and how it differs from what people associate with money printing, which has been quantitative easing.
It's the second, but it's correlated with the first. That is, it's pretty much precipitated by the inability in the bond market. Let me give you a historical example so you can understand better kind of how I think about it. In 1861, the federal government found itself in a civil war. The initial expectation was that the war would be over very quickly, but then when the Union troops invaded Virginia, it didn't go very well. And it became clear that this was going to be a more protracted war than they had thought it would be. They also decided, Salmon Chase, the Secretary of the Treasury, decided not to increase taxes. And so what that meant was that debt started to go up quite a bit. He had just stuffed the banking system full of debt in October or November of 1861. And in December of 1861, he revealed in his report, there's going to be a lot more spending needed. We're not going to do more taxes. And the value of government debt plummeted. There was that discontinuity that you referenced earlier. And he decided that he didn't want to play the game of raising debt with a much higher interest rate based on the market's concerns about the fiscal dominance risk. And so he immediately switched to inflation and produced, for the first time in U.S. history, the notion of legal tender currency in February 1862, which was then used to fund the government's debts. And because we switched to that legal tender currency, we also experienced substantial inflation.
Those are the greenbacks. Were the greenbacks issued concurrently with the passage of the National Bank Act?
No. They were issued in February 1862, and the National Bank Act is 1863. And they are a separate concept. The National Bank Act gave rise to national banks' issues of notes, national bank notes. They were called greenbacks eventually. They were initially called legal tender notes, and it is true that they were green, and so they were called greenbacks eventually.
Weren't banks under the National Bank Act required to hold some percentage of U.S. Treasury bonds or greenbacks in reserve in order to issue their own notes? I mean, I remember there being some relationship to the greenback, but maybe I'm mistaken.
So, no, you're asking a great question. So, first of all, just as that fiscal problem led to the fiscal dominance in December 1861, leading to a general suspension of the gold standard in the U.S. and a use of greenbacks or U.S. notes or legal tender currency, they're called all three, as a way to fund the government's war needs. Also, at the same time, the government said, well, we could expand the demand for bonds, because that's what fiscal dominance is all about, trying to find ways to expand the demand for bonds. If we can legally require banks to have to hold bonds as backing for any currency that they produce. And that was the National Bank Act. But this was an idea that actually went back about 30 years. And Salmon Chase, Lincoln's Secretary of the Treasury, was in fact a Jacksonian monetary enthusiast. And so this was an idea of creating this. There were some objectives other than fiscal policy that informed wanting to create a more uniform currency so that by having it all backed by U.S. government bonds, the currency and those bonds were collateral that was held at the U.S. Treasury so that they were almost like a separate bank within the bank. And so those currencies, those national bank notes, always traded at par relative to the dollar and relative to one another. And so there was an objective to it that reflected the desire to have greater uniformity in currency. So they taxed the state bank note issues out of existence with a 10% annual tax on outstanding notes and replaced them with a national currency. But it wasn't a coincidence that happened in 1863. It was an idea that went back to the 1830s. It happened in 1863 because it was a great time to increase the demand for government bonds. And they did that with initially requiring 111% of your notes to be held in bonds. And additionally, I think it was 5% or so of holding of cash in greenbacks. The greenback and the national bank notes were not legally interchangeable in each other or redeemable into each other, but they did trade at par. There were a couple of moments where they didn't, but for the most part, throughout the history, they did.
And they were eventually pulled out of circulation over time, redeemed by the U.S. government. I think a couple of decades they were out of circulation or so. So I don't remember where we were when I interrupted you for this clarification.
That's okay. I do.
Great.
So I was elaborating on your summary of my recent paper. And as you summarized it, there are really three parts to the argument. Number one is, as I've already said, everyone agrees that under current policy, we're on an unsustainable path. Number two, everyone agrees that the way economies handle unsustainable situations, when they hit the unsustainable situation, you get something called fiscal dominance. And what is it a dominance over? It's a dominance over the monetary policy that would have otherwise defined how much money you issued. So when you hit fiscal dominance, it means that the fiscal needs of the government dominate and determine the printing of money. So governments in that situation start printing money. But just to dwell on this for a minute, I think that people misunderstand this as a panacea that can necessarily fund all the government fiscal needs. It's not true. Even though it is true that government, by having a monopoly over currency, can use the printing press to fund fiscal deficits. That doesn't mean that the government can, through the printing of money, fund the actual real fiscal needs in their entirety. And so now we get into an area which, again, in the second part of my paper, I explore in some detail about what the limitations of the so-called inflation tax are. How much resources can the government get by using the printing press? And we can come back to that. But the answer to that is, in the current environment in the U.S., where banks are not required to hold any cash reserves, and where any reserves they choose to hold are paid the market rate of interest, the important thing to understand is that bank reserves are not part of the tax base of the inflation tax. And so the only tax base for the inflation tax under the current rules of the game are the currency held by the public, both within the U.S. and outside the U.S. That is the actual physical dollars in your pocket, the physical dollars outstanding. That's the only tax base. If we were going to actually fund the deficits that we need to fund through the printing of money, and if we confined ourselves to the current situation where we don't have bank reserve requirements, and we pay interest at the market rate on bank reserves, we would only be able to fund our needs by relying on the inflation tax of currency outstanding in our pockets. And the rate of inflation that we would have to run to fund our fiscal needs would probably be about 40%.
I want again to clarify something, and sounds like we're not going to lose the thread here because you have a good sense of where we're going. I want to clarify something that I think for a lot of people is probably confusing, whether they hear it here or they read it in the paper, and that is this reference to a tax base. Now, usually when people think of tax base, they think of all the people that have to pay taxes, and the tax base is basically anyone that makes over a certain amount. I don't know what the minimum is. But what you're talking about here is something very different. What you're talking about here is the purchasing power, the amount of outstanding dollars, the nominal value of outstanding dollars in the economy whose value can be siphoned off through inflation, which is why when you talk about a no reserve requirement system where competing interest is paid on reserves, which is why you're saying in that type of a system, the only taxable base is the currency, because that's the only place where you're not compensated for just sitting in cash.
Exactly right. What you just said was completely correct. And let's think about this intuitively. You're right. The tax is different. By the way, that's what makes the tax so useful when you're in these fiscal dominance situations. But so please let's talk about that in just 10 seconds. But let me explain further. Suppose the government runs a 40% annual inflation rate. If it runs a 40% annual inflation rate, and suppose that I hold purchasing power in my pocket equal to about a fifth of what I spend every week. So, I'm thinking of this in real terms. I buy a certain bundle of goods every week, and I keep a value in my pocket of real currency purchasing power equal to 1/5 of what I spend. I'm going to, over the course of each week, if inflation is running at 40% a year, then over the course of each, let's say, month, I'm going to lose about 3% of my purchasing power in my pocket because I'm not compensated with interest for that cash that I'm holding in my pocket. So over a month, I lose about 3%, so that over a year, I lose about 40% of the real balances in my pocket. Who gets that money? The government does. That money is a zero interest IOU from the government. And so the government gets effectively a tax in the form of the interest it doesn't pay on the currency that we hold in our pockets, just as you said. Now, coming back to why is this such a convenient tax? Well, first of all, notice you don't have to have a debate in Congress. You don't have to decide when do middle-class people pay what rate, upper-income people pay what rate. You don't have to have any of those debates. It doesn't require the House or the Senate to agree or the president to sign on. So it's an automatic tax, and it's also a somewhat invisible tax. I have found teaching this topic over the last 40 years that students, when I ask them, what's the inflation tax? They don't know what I'm talking about. And when I ask them whether they feel like they're ever paying or ever have paid a tax by virtue of holding cash in their pockets, they don't think about it. Now, in high inflation economies, where there's, let's say, 40% or 60% or 100%, this becomes something people talk about and they realize. And they spend a lot of resources in their lives avoiding holding cash because it gets very expensive. But in moderate inflation economies like ours, where the history of inflation is that it's generally been pretty small, people don't really even think about this as a tax. And that's what makes it so convenient for a government. When you hit the point of fiscal dominance, where you can't increase your real bond holdings by the public because the market's not willing to hold more real bonds of the government reverts to the inflation tax because that's very convenient to do immediately and quickly. It doesn't have to have a debate about tax policy, and many people aren't even aware that they're paying it. Those are the kinds of taxes politicians really like. And so in history, whenever countries have hit this point, that's what they do. They tend to rely on the printing press. But I want to emphasize, because now we are able, through our conversation, to realize that this is a tax, and it, like any tax, it has a rate. The rate is the rate of inflation, and it has a tax base, what it is that's being taxed. And in the case of our current system, an inflation tax would have a tax base of only currency because, as we've agreed, bank reserves, which are also holding effectively Federal Reserve notes, but those bank reserves are paid interest under current law. So now moving to the third part of the paper, I point out that that isn't likely to be the political answer. Even though it is true that we could pay all of those continuing real deficits, the real spending needs of the government for entitlements and military over and above what we take in as taxes, we could fund that through an inflation rate of about 40% on a small tax base of just currency held in our pockets. That's not the only possibility. Another possibility is that the government decides to go back to requiring banks to hold reserves, which we don't currently do. We don't require them to hold reserves as a proportion of their deposits, for example. But we have in the past. So we could require them to hold reserves. And furthermore, it's only very recently, just in the last couple decades, that the U.S. government decided to pay market interest on reserves to banks. So we now are paying market and sometimes above market interest rates. And that's a political choice. The Fed sometimes, to help the banks or to help money market mutual funds, it actually targets interest rates at above market, which is contrary to their statutory authority, but they don't get called on it. But anyway, let's just say market, but it's actually sometimes even above market. Well, if the Fed decided to change that policy to now require banks to hold a substantial amount of their proportion of their deposits in cash, and if we went back to the policy of not paying any interest on cash, we could get the inflation rate to be much lower. And so I come up in my paper with one example where you could imagine the inflation rate being maybe even under 10%. But that was just an example. Let's just say the point is that you could, by bringing those two policies back of requiring banks to hold reserves and not paying the full market interest on them, you could substantially reduce the rate of inflation. So now put yourself in the position of the government. Which is more popular, taxing the banks through requiring reserves at below market interest? Now, let's bear in mind, when you tax the banks, you're taxing bank depositors. We all understand that. But again, it's kind of invisible. It's not something depositors necessarily are aware of. In fact, through most of U.S. history, depositors suffered that tax and generally weren't aware that they were. At least that's what I found. So banks would be harmed because depositors would be harmed with lower interest. But if you were a politician, I dare say, now this is a political opinion or an opinion of mine about American political economy, that the equilibrium of political choice would be to bring back reserve requirements at zero interest and to arrive at an inflation rate, maybe it's something like 1/4 or certainly, less than 1/3 of a 40% inflation rate, which is what you would have to do if you were only funding the needs through an inflation tax on the base of currency alone. And so I'm making, in the final part of the paper, I'm making a strong argument from political economy that the most likely outcome would be that we would have to see the banking system be taxed substantially as part of the likely political economy. And by the way, that's just the way things work. All around the world, throughout the history of the last couple hundred years, when governments get into these situations, they tax not just the currency in the hands of the public, but they tax the banking system too, again, for the same reason. Because it's a convenient tax. It's convenient because it doesn't require any Congress to decide. The Federal Reserve Board is in charge of setting reserve requirements and the interest on reserves. And so through overnight, we could move to a situation where reserves are required and where interest is not paid on them at the market rate. And that would be very convenient also, as I said, because people aren't always aware as depositors of the inflation tax they pay as depositors. And then with the tax rate at something like 10% or maybe 11 or 12%, but you get the point, much lower.
But when you say timeout, because again, I want to clarify and then I want to, after you're done, I want to clarify everything again.
Sure.
When you say
Please.
The tax rate, what are you referring to here? You're referring to the inflation rate. Okay.
Right. So the point is the total inflation tax, the total resources you get from the inflation tax that funds the deficit needs of the government is the product of the tax rate, which is inflation, multiplied by the tax base, which is whatever the government is borrowing without paying interest. So that is always cash outstanding in the hands of the public, but it can also be the reserves required to be held by the banks for which they are not paid interest. And so the point is, if you expand the tax base to go from just currency to currency plus reserves in the banking system, then you can lower the tax rate, the inflation rate, from a number like 40% to a number like 10, 12%.
So just to clarify again, when you're talking about getting the inflation rate down from 40% to a different number, whether that's 16, 8, or something in between, by expanding the pool of capital that's subject to financial repression or confiscation through the erosion that inflation causes, absent a commensurate interest-bearing return on that capital that you would get by keeping it on deposit in the banking system or in a money market mutual fund or by lending it directly to the U.S. government, is another way of thinking about what's happening there that less money overall is actually being created because the government, through the Fed, isn't paying interest on the money held in reserve, some of which would eventually accrue to the depositor. In other words, less of the inflation tax that's being created is something that the market is being compensated for.
The point of the inflation tax is for the government to have an outstanding amount of IOUs that it doesn't have to pay any interest on. And that interest savings is a resource for the government that can fund the deficits. So that's the first point. And then the point is, well, what are the candidates for those IOUs that the government doesn't have to pay interest on? Well, the most obvious one, of course, is the cash that we all hold in our pockets because the government doesn't pay any interest on that. But another one is the government could construct that by saying to the banking system, oh, I'm going to make you hold cash like the public does in their pockets, just like that, without any interest being paid on it. And I'm going to make that have to be 40% of the deposits in your bank. So if you get $1 in deposits, you can only lend out at interest 60 cents. The other 40 cents you have to hold at the Federal Reserve bearing zero interest. Now, of course, that is what we're talking about. That expands that tax base.
And the scope of financial repression in this case.
Yes. Well, I mean, and 40% is a very, very high number. We've never seen that number in the U.S. in the past. I picked it as a number just to show how big the effect could be if the government did that. And then you recognize that that means that depositors, their interest that they will get on their deposits will now only be about a little more than half what it would be if there were no zero interest reserve requirements. So depositors are going to get clobbered in terms of interest from this. And so they're the ones effectively paying the tax through their holdings of bank deposits.
So let's also clarify something else, which I touched on early on, which is the difference between quantitative easing and the printing press or printing money in the context of what you're describing here. Now, in the case of greenbacks, it's a more obvious comparison. You're minting currency in order to spend into circulation. This is a little different. So what is the distinction between QE and what you're talking about here?
But even though they're on balance sheets, they look different. The process is really the same, which is the Federal Reserve buys the debt from the U.S. government, puts it on its balance sheet, the Federal Reserve's balance sheet. And now if the government doesn't have to pay interest to the Federal Reserve, then that means that when the Fed gets effectively the interest on the bonds that it's holding from the government, it gives that back to the Treasury. So I just want to really take you through so you can see that currency and reserves are actually the same. They function through the same mechanism because the Federal Reserve is issuing both the reserves and the currency. So look at it this way. Suppose I'm the Federal Reserve. I buy the U.S. government bonds that the public doesn't want to buy. And then I don't have to pay because the Federal Reserve notes they are in your pocket. Those are my liabilities. Just like the reserves the banks are holding are my liabilities because I'm the Federal Reserve. I don't have to pay interest either to the public. So notice that let's think about the Fed's balance sheet. I'm going to give a simplified version because I think it will help people see it. My liabilities consist of reserves held by the banks on which I pay zero interest and currency held by the public on which I pay zero interest. Those are my liabilities. They're exactly equal to my assets. What are my assets? Let's again simplify. Just government bonds that I bought. And so the two are equal. Now, if I don't have to pay interest on the currency or on the reserves, then the government interest payments are profit to me. What do I do with those profits? I give them back to the U.S. Treasury. So that means effectively the U.S. Treasury doesn't have to pay interest on those bonds, even though in a physical sense they're paying interest to the Fed, but then that interest gets sent back to the U.S. Treasury. So it's as if they didn't have to pay them in the first place. So that's the sense in which these are really the same thing. When the Fed buys bonds to fund liabilities which don't pay any interest, then the Fed makes a profit from that. And under our consolidated government accounting, the Fed just sends that back to the Treasury so that the Treasury makes the profit. That's the inflation tax. So whether it's the currency held by the public or zero interest reserves in the banks, the mechanism is the same. It's just that the Fed doesn't have to pay interest either to the currency holders or to the banks that are holding reserves. That means the Fed saves money and it passes its profits back to the U.S. Treasury. That's how the inflation tax is collected. It's the same for currency as for reserves. But I want to emphasize that's the system I'm claiming would happen under a fiscal dominance situation. Currently, the banks are not required to hold reserves of any given amount. And on any reserves they choose to hold, they are paid market interest.
So is it correct, though, to say that one of the key distinctions between QE and what you're describing is that when QE was initially enacted, it wasn't enacted because of a lack of demand for U.S. government debt, whereas in this case, it would be enacted because of the fact that yields were becoming excessively punitive, number one. And then number two, there's a commandeering of the banking system in order to use deposits in order to fund the deficit. and the debt?
Well, I liked what you said, but I think talking about QE is a little confusing because long before QE existed, that balance sheet was the same. That is, QE is just a monetary policy that drives the Fed to buy more government bonds and typically longer maturity government bonds. But all along, since 1917, the Fed has been buying government bonds as the main thing on its balance sheet. So whether you have QE as a driver, in fact, in my view, once you're in a fiscal dominance situation, QE or other kinds of monetary policy initiatives become irrelevant. What drives the Fed's purchases of government bonds is simply the fiscal needs of the government. That is it. Forget QE, forget forward guidance, forget normal kind of, monetary policy prior to QE. All that becomes irrelevant. It's just the Fed becomes a vehicle of the Treasury to buy the debt of the Treasury to fund the deficits. And the way the Fed's actions funds the deficits is by the fact that the Fed doesn't have to pay interest on all of its liabilities. That's why the Fed is useful to the Treasury. That's the entirety of it. That's the only reason. And that's why I'm claiming that the Fed will end up deciding to broaden that base of assets on which it doesn't pay interest.
So besides the mechanics of how this is done, I think the other major question that's probably on listeners' minds is when does something like this happen? And should we expect to see certain signposts, and what would those be? Or is this, are we already within the window of when something like this could happen and the change could be pretty sudden? How do you think about that?
So let me point out, when you do the arithmetic on this, what you are always looking at is there's a total cumulative amount of debt, which has a ceiling. We don't know exactly what that ceiling is, but the way we think about that ceiling has to do, that is that ceiling at 120%, debt equal to 120% of GDP, debt equal to 150% of GDP, debt equal to 200% of GDP. By the way, we're already at more than, from the standpoint of the right way to calculate it under the current situation, we're already at more than 100%.
Well, also, just to throw in there also a question, which I don't think you addressed in the paper, but I thought about, which is, what about the average duration of the debt? How important is that? And how do you quantify something like that? Because in mid-1965, I think the average duration of U.S. government debt was somewhere a little over 5%, and today it's around 6%. So, is there even enough data around that to be able to determine what role that duration would play, or are we really winging it?
Well, the duration of the debt, that takes us into a pretty complicated point, which we might want to save for a minute, because now we're in the realm of talking about the difference between what's called the unanticipated inflation tax and the anticipated inflation tax. And I'm worried that if I start to explain this, I might be giving some of your listeners a bit of a headache.
Okay, let's go in your original direction,
and then
we can come back to it.
Trust me on this. I think it'd be a better sequence. But what I want to say in answer to your prior question is that what's going to determine the point of unsustainability is going to be the cumulative amount of debt relative to GDP hitting a certain ceiling. But that ceiling is defined by the difference between the rate of GDP growth looking forward in perpetuity and the real interest rate paid on U.S. government debt. So I just want to say this is how the arithmetic works. There's a numerator, which is debt. It grows by the nominal interest rate. There's a denominator, which is GDP. It grows by the nominal rate of GDP growth. And it's so that what that means is that the key thing in deciding what is a sustainable maximum ratio of debt to GDP is the difference between the real interest rate you have to pay on your debt and the real growth rate of the economy. And that is subject to change. So finally, now to answer your question, how quickly could this happen? Well, over the past 25 years, the real interest rate has fallen from its historical average of about 2%. It fell to about 0.5%. And that's why all over the world, the global real interest rates have declined. And you're seeing governments and corporations substantially increasing their debt, because when interest rates fall, the amount of debt that is sustainable goes up because the ratio of debt to your GDP, if you're a government, let's say, becomes much higher when holding constant your rate of GDP growth when the real interest rate declines. And so what you're seeing is all governments all over the world are doing what the US has been doing too, which is increasing the ratio of government debt outstanding relative to GDP to take advantage of the low interest rate environment. But that seems to be changing. We seem to be reverting to a more historical average rate. So very quickly, it is possible. We as economists don't really have a good sense of why interest rates fell so much over the prior 25 years globally, from about a 2% real interest rate to about, at its lowest point, about 0.5%. And now what we're seeing is, it looks like it's going back in the other direction. And there are many people who are saying that there are reasons to believe that the forces that pushed it down might now be pushing it back up. We don't have that answer. This is not something that we as economists understand very well, what's driving that. But my point is very simple. Governments have issued a huge amount of debt over the past 25 years, especially because it's been so cheap to issue debt. If that changed, and it does seem to be changing, but if that changed, and it could change even suddenly, so that we went back to, let's say, immediately, I'm not claiming this is going to happen, but I'm just as an example. Suppose we went back to immediately a 2% real interest rate. I would say we're already at an unsustainable point with a more than 100% government debt to GDP. So that gives you a sense of how close we are to the unsustainable point. That if real interest rates reverted immediately to their historical average, we would already be at the unsustainability point. That's because we would already be at a point where, looking forward, our debt to GDP ratio under current policy was on an unsustainable path, that people would be able to see very clearly that not only are we in a long-term unsustainable path, but maybe in an immediate term. Now, the way that that will show up, you asked about what are the warning signs of that? The obvious one is interest rates start to go up, so that you start to see what's called an inflation risk premium. This is something that was very large in the US during the 1970s and the early 1980s, that in addition to the interest rate on government debt and on all other dollar-denominated instruments, taking into account the expected rate of inflation, it also took into account the risk that inflation could go up. And that inflation risk premium, we also see historically in other countries and in the US at times when it looked like the US might adopt a more inflationary policy posture. So even before the inflation tax happens, the government debt market starts to anticipate the risk of it, and then the interest rate starts to go up. And that becomes a precipitating influence for bringing on the inflation tax, because the government starts finding it very expensive and then eventually prohibitively expensive to continue without using the inflation tax. And again, I already talked about the example in 1861. That's what happened. And I think something like that is the way to think about what's going to happen. That is, the global real interest rate is already going up. It's putting us into an environment where within, let's say, 5 or 10 years, it's hard to be specific about it. Within 5 or 10 years, the bond market is going to get vigilante-esque, as we like to talk about the bond market vigilantes. They're going to start to see the problem on the immediate horizon. Inflation risk premia in the bond market are going to go up. The bond market's going to get spooked. There's probably going to be a failed auction where the government is surprised at a sudden change, a sudden jump in interest rates, and then it's forced to contemplate how, under that changed condition, it's going to be able to fund itself. And then you're going to see some kind of monetary policy changes along the lines that I've been describing. At least as a financial historian, that's how I think about the sequence. Trying to say exactly when it could happen, I can't, because I don't know what's likely to happen with real interest rates. But that's the driver. The real GDP growth in the U.S. is not likely to change suddenly. It's going to stay around, I would guess, somewhere between 1 and 1.5% for a long time. So under that current policy, the real source of deciding how quickly things happen is going to be real interest rates. And I want to emphasize, certainly it's going to happen in 20 years. There's no question that we'll hit that point within 20 years. The Treasury even has admitted as much. But could it happen within 5 or 10 years? Yes, it could.
So I want to move the second hour of this conversation onto the premium feed, Professor. And here's what I'm kind of thinking about that I want to explore with you there. One is I want to dig deeper into this concept of like signposts and what might we see, because we already have seen discontinuities in the bond market. I mean, we saw discontinuities in the repo market in 2019. Again, there are policy reasons for why that happened, or explanations that lean on policy changes. But we also saw discontinuities in the UK bond market. And one of the things that I've thought about in terms of trying to think about when something like this could occur in the United States is that I would expect to see it happening in other bond markets first. So that's one of the questions I want to ask you. I also want to get a sense from you about what the trade-offs would be in such an economy. What would an economy that's operating under fiscal dominance look like? And once you're in a phase of fiscal dominance, is that something that has to play out until there's some kind of just overall funding crisis for the government? Or can you get out of it through inflation, that you generate enough inflation that you burn off the debt, and then you're able to kind of restart a period of higher growth where the private sector is not burdened by that kind of financial repression or credit rationing? Which
so let me answer the last
we're going to move to the
question
second.
first.
We're going to move to the second hour for that too.
Yeah.
But I would also say, and then I also want to talk about something that I mentioned at the very beginning, which is fintech and crypto, because you've written several papers on this, and I'm curious
it's
to imagine
very related.
how those are going to be impacted as well, and how government regulation could possibly try to dampen their effect, because those are sort of off-ramps to the corralling of capital in the killing pens of fixed income, which is what Russell Napier has called it in one of our previous episodes together on this podcast. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Professor Calomiris, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Charles, stick around. We're going to move the second hour of our conversation onto the premium feed.
Great.
If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.